Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody, and and welcome to the day. Federal Reserve Decision Day. I'm trying to be all dramatic, though. I totally blow it. Hey, guys, let's go to the charts here. Yesterday, in the treasuries, we had a little bit of a hawkish move that then magically reversed, probably due to COVID uncertainty because the guys in London keep scaring everybody. White mustache, is it bad? Am I? Yes, it is. There we go. Thank you. Okay. Yeah. So now today they're getting hawkish again. Kind of at the moment, it looks like maybe the call is to just go short. But the treasuries here on the open, just, it's been a few 5 minutes. They've only traded 3 prices. It does not look like they are too anxious to get trading. So S&P 500 took a real beating yesterday. I think we'd need to get back into like these non-farms levels to really start triggering like severe panic. I know. I still think that this is the downside is driven primarily by Omicron variant fears. Of course, rising interest rates is also a concern, but like the bond market, the interest rates aren't rising, so like it's hard for me to sort out how much of it is that and how much of it is that, right? By the way, the 30-year spread has actually been fairly flat lately. So now oil drifting a little bit lower, right at $70 right now. It looks like supply is doing better than anticipated. There's still a lot of factors to think about over there in oil. So that greater supply coming online, I don't know, with it pushing it down a little bit, maybe it's not such a big deal. I still feel that oil could be a pretty good reflection of the economy, and I still think that there's a pretty good chance that in the next 1 to 3 months that they come back up into the 80s. Okay. Now, natural gas, after seeing a plunge 2 days ago, they're starting to see, they're trying to make another little bit of a run. Natural gas could just blow out here, especially if Russia invades Ukraine in January, February, which the U.S. has some, the assessment is that they are going to try. So just keep an eye on that one, right? Gold and silver, not doing so hot. It's still within the range, but not so hot yesterday. And coming back and looking at the dollar here, the dollar just continues to be strong. And here is where I feel that Omicron variant fears are probably driving some flight to safety, especially since it's the Europeans that are scared. So what are they doing? They're putting all the money in the U.S. And we got Bitcoin pushing some ugly levels, dipping below 4,600 briefly, coming back up, but now on the downturn again. And it will be interesting to see if the Federal Reserve comes out and is more hawkish than anticipated, if Bitcoin doesn't come out and just puke. Could happen. Oh man, if Federal Reserve, usually Federal Reserve decision tends to trigger some price action, but like if they're at those lows and it like triggers stops, that could be absolutely hilarious. By the way, we've got to talk about the real important stuff, though, right? Yesterday, I can show you here. Coin market cap hacked. Screwed up. Well, I don't know if it was hacked, but the prices of everything on coin market cap was messed up. So for a brief few minutes yesterday, I was a multi-billionaire on paper. But alas, it did not last. I've always said, it would be like my goal is to lose $1 million. Like, you must be doing pretty well to lose $1 million in a day. Well, I guess I've met that goal. I guess I can cross that one off my list because I made a 35 billion dollars and then lost it. So. And they really, oh man, what happened was Air Cages came into chat and posted a picture, and I was like, wait, what the heck? Okay, wait, we getting some numbers here. I'm sorry. We are going to get US core retail sales here in 30 seconds. When we're looking for a reading of spot 9%. That's why the treasuries weren't really moving. You also get New York Fed manufacturing. That's also important to watch. Okay, so New York Fed manufacturing was pretty good, actually. 31 versus 25. But core retail sales was spot 3 versus spot 9. Wow. So they care a lot more about the retail sales. Is pushing the treasuries up a little bit here. Yeah, well, I had kind of forgotten that we had retail sales. So I'm wondering now if they're going to do that move, and then if people still want to get short the treasuries before the Federal Reserve, that after this calms down and the liquidity returns, that they do that. Great action yesterday. Well, we made a good trade yesterday, but it was a real mess, I felt. I think we kind of got a little bit lucky in how we were able to take profits on the trade that we had. A little bit lucky, I think. I should put the warning out here. I mean, I retweeted Anthony Crudelli's post on this and then kind of put my own comment on it. But I just want to reiterate to you guys, this week in particular is likely to be unusually volatile and confusing. Maybe very likely. Well, I shouldn't say very likely, but the sorts of things that you should have on your radar is like if the Federal Reserve comes out and is exceptionally hawkish, and then the treasuries like absolutely crater and then reverse higher, or the S&P 500 hates how hawkish the Federal Reserve is and plunges 200 points only to buy like insane when all of the gamma expires on Friday. Okay, like this market is going to be prone to doing bizarre, confusing, excessive things, and if you choose to trade it, then honestly, if you have a small account, I would recommend just saying, I'm probably going to sit out here. You've really got to be on your toes, man. So yeah, it's you got to remember, like, you would think in this kind of situation, okay, the big decision has been made, it should trend, right? But in this particular case, I don't think that that's necessarily what happens, because there's already pretty solid expectations about what the Federal Reserve is going to do. And I think, because there's not a lot of room, in my opinion, for a really strong surprise with the Federal Reserve meeting that it would take to create trend. Instead, what you're going to get is you're just going to get a lot of trade off of it. And remember, it is the trading in and of itself that creates volatility. So if there is that much interest around an event, you're going to get a lot of volatility. And, the situation is such that I don't think that it will be trendy volatility, which is what we would love, right? Some volatility, but strong trends. I think that it will whipsaw you. Good morning, Eric Ages. We already talked about how I'm, was a billionaire for an hour, but I tell you, my dream was always become a multimillionaire and then lose $1 million of it in a day on a dumb trade. That was, but it's happened now, right? I was a billionaire and then it's gone. So I'm going to have to come up with new dreams. This is the problem with being so amazing, guys, is that you do all of the things that you want to do, and then you have to find new stuff to do, and that's hard to figure out. That must have felt good. No, honestly, when you came in and you posted that, I was a little upset. Like, I saw that picture, and immediately, of course, I'm like, there's absolutely no way that garlic coin could be worth $1 million a coin. That's ridiculous, right? So I'm thinking, okay, they must have done something. Like, is somebody manipulating this market? Is it going to come back down? What's going on there, right? So I thought it was manipulated, it was fake, but I thought it's just garlic coin. Like, my initial thought was it was just garlic coin. And if they're doing this, maybe that would actually be good for garlic coin in the long run. So I was happy about it, but I was a little bit concerned because I'm like, is garlic coin like going to take off now before there's like more widely traded and better liquidity for me to get out into and stuff like that? But then I started going to CoinMarketCap front page and I realized that like every cryptocurrency was doing that, and then it's like, oh, I want to become so rich I could lose it all in no, I don't want to lose it all in one trade. Just $1 million, and to have enough that $1 million isn't a big deal. Like if you're worth 100 billion, then $1 million, losing $1 million in a day ain't a big deal, right? Okay, well, they had their little push up. They're coming back already. I think that right here at 1.449, 1.5, I don't see anything in the order flow or anything like that, but this might be an okay spot just because of how it turned down to try and position ourselves long rates if we wanted to. I am still of the opinion that I want to be extra cautious, and I'm really going to need to feel really strongly that rates are going to rise to take a trade. And if I do take one, I might not really try and let it run. Am I going to stream FOMC? Of course. Of course I'm going to stream FOMC. It's going to be a big... and yeah, like I said, I'm going to try to not be in a position when it happens, so that we can just make fun of what they're saying and have a good time. Yeah. Something I hate about bagels is the pieces of bread get stuck in your teeth. Yeah. Times of Israel on the Celsius network. The company's chief revenue officer recently established a side business with a convicted money launderer. Celsius said it had no obligation to disclose. Okay. That's what you want to see if you're in the cryptocurrency industry, right? So one of the things that's making me think that, hey, maybe here's an okay spot to go long rates is because off of that news, it appears that there was some steepening in the spreads. Not super strong, but some steepening in the threads. This lady, you gotta participate. She's so I've been getting people that come in and are just posting links now, which I thought, well, it won't. You can post a link, but it won't like put the thing on it. I'm just gonna kick them. Maybe they will get the. I'm okay with people promoting stuff in Discord if they're participating. If they're participating, then you can link stuff all you want. As long as you're participating and it's not bullshit. Or other rooms. Other rooms is another one. There's some people. There's been a couple of incidents on Discord where we banned somebody and they're like, oh, you let so-and-so post stuff, but not me. Because you're posting a room! Good grief. It's like, yes, let's come to the room. And then try and lure people away from the room. Yes. You think we're going to allow that? Come on. Come on, people. Mm-hmm. Twitch really wants me to visit them, apparently. Chat with new people right now on Twitch. Yes, screw that. Twitch sucks now. To be honest with you, Twitch sucks now. Okay, so. Still sitting there. Let's reset things so that we kind of get a good, good benchmark, so I can take my eyes off of it here for a bit. Browse around. Yeah, that was a pretty. Let's see what Zero Hedge said about the retail sales. After October's big upside surprise print, U.S. retail sales are expected to slow their roll a little, but still rise for a third straight month. Analysts were right on direction, but significantly wrong on amplitude as headline retail sales rose just spot 3 month-over-month, well below the spot 8 month-over-month that was expected. Core retail sales also missed. The softer-than-expected report may reflect the pulling forward of holiday sales as many Americans aware of supply chain slowdowns shopped earlier than usual, or as Bank of America noted last week, consumers have started to react to the Omicron variant. Total airline spending slipped noticeably to negative 15% on a 2-year basis, down 13% from the week prior. The weakness seems to be driven by cancellations of international trips. Indeed, Bank of America found meaningful pickup in refunds from non-U.S. carriers and little change in refunds from domestic carriers. Most notably, retail sales control group, the data that feeds into GDP, actually shrank spot 1% month over month. Finally, remember that retail sales are reported on a nominal basis, and thus it is unclear how much of the rise is simply due to inflation. The chart below, while overly simplistic given the vastly different weighting schemes, attempts to adjust retail sales monthly change for the shift in CPI, and the picture is quite different. As adjusted for inflation, retail sales dropped in November. Will today's print be considered in today's Fed decision? I don't know. Do you watch /trade Forex as well? Well, so the little chart that you see in the upper right corner of the screen is the dollar index. So I have a nifty little indicator that will synthetically calculate what the dollar index is based on the futures. If I'm going to trade a currency, it's going to be on the CME. I'm not really a fan of like Forex because you're basically trading against your broker. But following what the currencies are doing is important. Well, they're coming back hard. I don't know. I'll give it a shot. This one contract. Just free money's run out and video cards still expensive. Dude, video cards are so ridiculously expensive. It's really quite something else. Alfred, good morning. How are you? I would really like to see the price of video cards go down. Like, that's been one of the big holdups for me. But like, when I sat down and looked at it, I was like, well, because I try to keep the business revenue neutral for, so they don't have to pay taxes on it. So everything that I make from the YouTube, I throw back into building the business. And so I thought, well, I could build a nice new machine, or I could get the new camera. And I looked at it and then I realized, number one, this new camera that Sony's putting out in December, the A7 IV, is going to be a big deal. Like, I think that all of the YouTube creators are going to move over to this camera, and that is going to be the dominant camera in this space for several years. So that played into it. But then the second thing is I was like, well, I could build a new machine, but I'm have to pay out the nose for a freaking video card. Now I may have to do that anyways, because if I'm gonna move over to like doing 4K video editing or something like that, I don't know, man. They're just way too expensive. It makes little sense to just shop for separate video cards, while PC with video card, like at Micro Center, costs about the same. Yeah, because you can, but it's still like way more expensive than it should be. Like this machine that I have here, I'm seeing people sell machines for similar specs for about the cost that I paid for it. Now, when I bought it, I already had the video card, but still, it's just insane. What is the contract size of ES, sir? So, how much, like the contract size of it? That's not what I would look at. So what I would look at is the tick size. Excuse me. The tick size is in the full ES contract is essentially $5 a point, or $1.25 per or sorry, $12.50. It's $12.50 in the full ES. It's $12.50 and a full point is $50. Okay. But the actual number of like index points that it is a little bit more complicated. But I wouldn't look at that. I just wouldn't look at that. Period. What you really want to know is how much are you going to make or lose on an individual trade, right? The average like rotation in the S&P 500 is 12 to 16 ticks, and that's going to be equivalent to $150 to $200 on the full ES contract, or $15 to $20 on the micro contract. Yes, that's why most people trade the micro contract, because when you go in and you look at that and you say, okay, that's what an average rotation is, but like then you realize that like it dropped $100 yesterday, and that's like $1,000 or so that you could lose. Poof, right? A good starter setup is 10 lots for no. You start throwing 10 lots out on the ES, and the market's going to immediately be like, ah. You might be easier to get away with that sort of a thing on an index, I suppose. You started throwing stuff around like that on oil, the oil market would definitely punish you for it, I think. Move this. And move this. And need that right here. How do you find the average rotation for mini NQ, for example? So the way that I do it, I mean, there's a bunch of different metrics that you can use. A lot of people, they want to look at the actual swings. So you can go and do like the zigzag indicator and like do statistics on the zigzag indicator. But I like to just do it based on a time period. So if we were to come over here into the ES and do 30-minute bars, okay, because 30 minutes is like a good, like this, how long might I be in? Okay. And then I'm going to come in here and I'm going to add my stats range histogram. Okay, and what this does is it shows you a distribution of the range bars here in terms of ticks. Okay, so now let's come in and change the data series so that we're loading like let's do 250. Let's do 250 days. Right. Yeah, zigzag percentage. The thing is that they all... The reason why I say like there's a bunch of different ways to do it is because they all tend to give you the same stats. So just note here, it's pretty solid distribution here because it used to not be, there used to be more clear like plateaus and they used to be in different spots. Like it just kind of shows you how volatile things have been in the few months. But do you see right there? Just realize this is an exponential. This is an exponential scale. So these ones are significantly more common than these ones. Okay, and there you can see that around 12 to 16 is where the most of them are. Actually, we should change that. Let's not do, let's just change the data series, the trading hours, to use the STH hours. That will just be like the most active market hours. Okay, that's a little bit better. So during the most active market hours, they're actually right now pushing 20 ticks. Is the most common. So, and then the value area is around 53, 55. But you can see that there's kind of like this drop off around 64 ticks. More than 64 ticks, and all of a sudden it's like it's too far. Why would the market punish one if it puts in large orders? Well, so the market will react to your trades, right? And what they may do is so the general way that it's going to work is that a market maker is going to adjust their price based off of the volume that it's getting in. So if you start putting in a big trade in there, they might pull their prices and give you a worse price in anticipation of what you're doing. But then as soon as you get in, if they're not seeing other volume the other way, they will adjust the other price the other way, and your order is going to have an impact the other way. So if you just buy it and then turn around and sell it immediately, on average, you're going to lose money. That's the way it tends to work. Now, how big do you have to get before that impact is like noticeable? Yeah, I don't know. Kind of depends on the instrument. Or we're just saying, like, if you were in mini NQ and you were putting like 10 to 20 at a time in there, like the market definitely reacts to that sort of thing. And you can see it happen. If you go and you get like a good, where is it? These things right here, right? Here's the ES. So you can see there's, these big lots like 100. Just kind of watch this thing and see how the market reacts when those big lots go through. But that one is kind of more like right now. Like I wouldn't be hitting NQ with 10 contracts right now because it's pretty in favor or against. Well, it's kind of, the thing is that when you take the initial trade, it's might move in your favor, but then when you get back out, it's gonna move the other way too. I know. So you'll see it sometimes in the micros. So a really good example. When was it? So last Wednesday, last Tuesday, something like that. I came in and I took a trade in the 5-year. I was the only person that had taken any trades in the micro 5-year. Okay. So it was something like, oh, okay. I bought into 1.27, right? Or maybe it was I took a limit order or something like that. Okay. Let's say that you took a limit order at 1.265, right? Well, there's this spread here, right? And they're saying that the spread right now it's reasonable to be between 2.6 and 270. They'll switch around and they'll say it's 260 to 265 simply because you took a trade there. So because you bought, they want the spread to be unfavorable to you, so that if you do end up puking, you're going to have to take a loss on it. And like you can see how as soon as I took that trade, I don't remember if I took a limit order or what, but you could see how as soon as I took that trade, they switched the spread up to be not favorable to me. Because they're market making and I'm the only person that's taking a trade, and so then it really has an impact, and you can see really clearly how they sorted it out, right? But people think that, oh, it will like target me, right? That it comes after me. It's not that. It's because what it's doing is it's just doing overall statistics on the flow that it's seen come in, right? And it's just going to be that the market maker is always going to make things unfavorable for the flow that it saw come in, because it's trying to make money against you, right? Is it just a spread? I mean, in that instance, I think it's just a spread, but I like your liquidity hole theory, but it isn't pretty much the same as the trading range sideways market action. Well, so I think that where it becomes useful is because you can predict where they're going to be, right? So, of course, you can come in and you can look at a market and you can say, they're stuck in range, and I want to try and play that range, right? But how long does it need to be before you realize that the trading range is there, right? Liquidity holes, there are situations where you can detect that a liquidity hole has formed and that it is going to range around that location the instant that the price trades. There were some examples yesterday. Actually, let me show you. So, is it not going to show me? Oh, come on. For some reason, some of these holes aren't showing up as tech replay. Well, I remember where it was here yesterday. There was like a liquidity hole at like 146.70 or so. And so like literally the instant that it touches it, like people, you might not think you might have seen a move, but you might not realize it's a big deal. And then what happens? Starts rotating around that price for the next like 30 minutes, right? So is the ability to tell in an instant at this, you see something at this very instant, and from there, that for the next 30 minutes is going to stick around that price. Is that useful? You betcha. Maybe the unfortunate thing is that the most usefulness from it is that, well, you definitely don't want to enter into a trade there, right? Or maybe you want to get out. Or maybe if you really think that this is going to run, you could work your position in there, right? So is it useful for the people that are executing large trades? It's crazy useful, right? For the people that execute the large trades, it's everything. And because that ends up being everything for the people that are executing the large trades, now it becomes even more useful to us, because now I can sit down and I can say, okay, like a really big order where like they trade a bunch all at once, that has a possibility of creating a liquidity hole, right? So if I'm a big player and I'm executing a meta order, I'm going to avoid doing that, because I know that as soon as I do that, it's going to disrupt the liquidity and keep things in a range there. And I might not want that at that moment, right? So if I do see an order like that, it's probably not from the guy executing the meta order, is it? It's probably from somebody that was the wrong way and was stopping out, for instance. So that might be able to tell you something contextually in certain situations about how strained, certain people are. Right? But then it also kind of tells you how they execute, right? They do it in these waves. And so if you know that the meta order is being executed because you're informed and based on the expected flows for the day, there's a strong probability of a meta order like that happening, then as soon as you start to see the meta order, you can see how it's going to go, right? So right now, let's try and apply it to right now. Let's come back and look at my 10-year. So on this news, we had a pretty strong move up on low liquidity. So you can see we moved up there on low liquidity, which in and of itself is kind of like a liquidity hole, right? And then we came back. So just realize that above 19, like from 20 to 24, there might be light liquidity, right? So if somebody decides to come in and buy this, it might flip back through there, right? There seems to be a little bit of a hole at 19. Okay, so that might be something they fall back into as well. It's going to be interesting to see which way they go here, if they flip back up or not. But notice the volume here. Okay, no liquidity. And then after things calmed down a little bit, they sold it back down through to the tune of about 6,000 contracts. Okay, so if we're expecting a sell meta order today, do we have enough evidence to say that the meta order is occurring? Potentially, yes. So we don't know for sure yet. It's not super strong evidence, but we have some evidence that the expected sell meta order is happening. Okay. So if the expected sell meta order is happening, then what should we expect to see? Okay. Liquidity hole, maybe a push back into this hole, fall back in through there, and then in about it might happen just before the E-mini opens, or maybe it will happen as the E-mini opens. We'll see another leg, right? So we kind of know what's going to happen. So if we're in a position right now, and it's like 7:45, so let's just come back here. Let's make sure that I'm not missing anything. Okay, yeah, so we don't have anything until 8 o'clock. It's the housing market. Okay, so probably we will see. If this is going to do this, we're going to see another meta order probably around 7. So if it's like 8 o'clock and we haven't seen more evidence of a meta order being executed, then it's not happening, right? There's no more reason to be in the trade. So would you only trade the range or try to catch a breakout from the hole? Well, so trading the range is a little tricky, right? Because you just got to remember that if the hole is at 19.5, the probability of me getting a fill anywhere around here it's going to be hard. It's going to be hard to get fills. Should I say the probability is low? Yeah, it's going to be difficult to get the fills. And if you are getting the fills, then you've got to be really concerned about that you're going to get adverse excursion, that there's more flow coming in and it's going to push through you, right? This is kind of part of why the liquidity hole happens, because the market makers know that it's not necessarily the best place to do market making, right? But for sure, if I'm already in a trade and I'm in a liquidity, hole, and I don't have a reason to think really strongly that it's going to continue, then getting out at the liquidity hole is a really, really great option. If you've had some momentum going into it, you see a hole, you should expect them to push a little bit further and then come back to it. Okay. So like if I had been short from 24, let's say I was short from 24, I don't necessarily expect this to be a trend down day, which is not the case. Today, I think that there might be more selling because of the Federal Reserve. But let's just say that we don't expect that to happen. We come down here to 19, and I see something that has the potential of creating a liquidity hole, then I might get out at 19 there, depending on how quickly it is. But if it's really trending and it really came down strongly, then I'm going to try and see them make another push below lows and get out at that spot. And then they're going to come back to 19.5 and maybe I can get short again. That's how I do it. Just remember that there is more, the market, there is more inefficiency in informational edge than there is in statistical edge. So I had a way of saying that yesterday that I thought was the best, and I was trying to do it again, but I just got confused. It's easier to find edge in information than it is in statistics. Okay. So should I take a trade because I saw a liquidity hole? No. But what it can do is it can inform the trades that I'm going to make based off of information, right? It can help me execute it more efficiently. And maybe I really want to go short. If I really want to go short, is now the greatest time to get short? Well, there might be some more meta order here. Now it's at 705, but it's probably not. Probably not. It's likely to kind of chill here a little bit. Can you see the holes on a candlestick chart when you're using a regular volume indicator? Well, you will probably see them. I mean, you're going to see it in the volume profile after the fact, but to really see these as they form, you're probably going to need to see the orders. So let's just remember what creates liquidity holes. Market makers not wanting to put a lot of liquidity. There's not a lot of latent liquidity at that location. So what are some things that could create that condition? One thing that can create that condition is price moving too quickly through that area. If they just like outright completely skip certain prices, that can create a liquidity hole. A large trade going through at that location, like lots of volume happening very quickly, can also cause it, right? And can you see that on a candlestick chart? Not really. You want to watch the DOM to see that. Oh, Gus is asking about the distribution, the range histogram. That one's on Futures.io. Let me give you the one that I have. I've been like a little wishy-washy on how I wanted to like organize the indicators and put them together and stuff. But I think that I've coming up with a new scheme. So I think I'm probably going to need to do some rearranging of my indicators a bit here over the break. Speculative stats, range histogram. But I should make sure that it's included in the package for you guys. I'd like you to see call out more of these liquidity hole setups. Well, if it happens, we'll see it. So if it happens in the S&P 500, you'll hear a sound. If we get a skipped prices, we get a sound, and then you know it's there. There's also like, well, you can see the limit orders moving around. That's what the clicks that you're going to hear are. We definitely have a little bit of it going on here at 19.5. I think, though, that this one is a little bit less liquidity hole as much as it is just people resting after having a decent move. But because you're not, one of the key kind of tells is like them pulling. Okay, so like you see how they traded up at 19 and then 19.5 almost immediately pulled and there was only 300 contracts, and then look, they traded through that. Nobody puts anything in 19.5. And then I bet you that if the 5-year ticks down again, that 19 will pull really easily too. Like you're never going to see a large amount trade there simply because nobody's willing to hold that much liquidity. You see the 19 pulled now, 500. It's like the amount of latent liquidity that's there is just not. It's just not there. The market makers know that is a spot, and they don't really want to take too much of a risk there. Okay, now that one, they traded through the 19 and the 18.5 pulled. Did you see that? But what we should also expect to see on a liquidity hole is on the edges of it, they're not going to do that, right? It should be the case that here at 18 for them to trade through it probably take like 1,500 or 2,000 to trade into new lows. If that doesn't happen, then something is changing in the liquidity and we might be creating a hole below us that will suck us down. So 18, not too strong, but we'll have to see 17.5. It looks like just based off of that action that we saw just there, that first of all, the liquidity hole probably extends from 20 down to 18. But that number two, I think the bigger thing is that it looks like that the book is still pretty finicky right now. So if they decide to have another leg of this order, it could probably push it, because it doesn't look like market makers are really all that anxious to hold any price or to put a lot of volume out. Those bids in particular, we'll have to see. I mean, I would like to. It's always good to have like really strong contrast, right? Like they trade into 17.5, it only trades 500. But then if they try to trade back up and they go into 18.5 to like 2,000-3,000 contracts trade and it doesn't tick up. Okay, Willie has a good question. I saw your order flow videos and they make sense for ZN, but can you actually read ES order flow? So you can. It's more difficult. There's another thing that you have to factor in with ES is that it is an index, and so it will move sometimes because it's an index and not necessarily because of order flow. Order flow is not as influential in ES as it is in ZN. But the bigger thing, and what you're looking for, is that yes, you can read it in ES, it's harder. But you kind of have to, again, you want to look at things over time, and you will want to look at them over a range of prices too. So what I've shown you guys in the videos so far are like very specific setups, right? And what you're going to get in the next video is I'm going to show you how we kind of use those individual setups and what we're seeing happening at individual prices to build a picture of what the larger liquidity looks like. And so what you want to do in the ES is build that picture about what the larger liquidity looks like, right? So you want to be able to draw in your mind this sort of thing where it's like, okay, there's a liquidity hole right here. There's lots of liquidity right here, but they're trading through it because there's lots of market orders, right? And I should be able to see all of the different forces and judge how it's moving to manage my trade. So it's really hard in ES, and I kind of feel like you get in this mode. So like the thing that I have a hard time with is like if I come in here and I trade the 10-year and I'm getting really good at trading the 10-year, and then I'll come over and I'll take an E-mini trade and I'll lose every time because my brain has adjusted to the order flow in the 10-year, and the order flow in the ES is different, and you have to watch the order flow in the ES for a few days and get back used to that to adjust to that. It's like the whole machine learning thing that I talk about in the first video, that when firms do this, they put it, they attach a neural network to it, right? So a lot of it is just going to be your experience in reading ES. But the things that I showed you in the videos before, those are all concepts that you want to be able to see in ES, but the next two videos are going to piece it together for you to where you can really kind of understand what's going on, right? But what we've been talking about here with liquidity holes, that's basically what we're going to get into. I haven't finished writing the scripts for that, so it's still, but we'll see. But I have to tell you, Willie, trading indexes is hard. Like when I talked to the traders at Goldman and they're like, well, what do you want to trade? And I was like, well, I trade E-minis. They kind of laughed because it's like trader crack, and it's really hard. Like they don't trade or market make in ES the way that they might in other instruments. In ES, they're more likely to be looking for arbitrage opportunities, if that makes sense. This whole thing where they try and look at how different are the futures from the underlying index, and when it gets too big, then they start to put in on these arbitrage trades, buying the stocks and selling the index, or vice versa. But I don't know. I guess the thing is, I hope I made it clear in the videos. People want to be given setups. And in those videos, I do kind of talk about specific setups, but I'm not talking about them as like, this is a trade that you should take and trade all the time. I'm explaining it as this is a behavior that happens in the limit order book frequently, and this is why. If there isn't very many contracts resting there at that price, you're quite likely to see some market orders come in and try and hit it to try and catch the edge. If they hit into it and nothing happens, for a while, they probably bail, right? But when you watch the flow, you can see it happening. All of a sudden, it's like, oh, okay. Well, that's why that happened. That's why that happened. Then you come over into the ES. You see the same things. It's just, it's happening faster, and it's happening across a bunch of different prices, right? And you'll see them go, like, try to catch the edge, and they'll slip through a price and then kind of pause and see if anybody's willing to hit into the next price. And then if they don't, they just bail. And it's the same thing. It's catching the edge. Or if there's an iceberg, you'll see absorption, but you'll probably see absorption across a range of prices. I hope that answered the question. I have to admit, it's a difficult thing, and I haven't gotten very good at trading the ES, to be honest with you. I've had some success with it, but overall, I do so much better in the treasuries. Can you tell us more about the arbitrage, please? Okay, so like A really good example of a place where we could probably do some arbitrage would be here in the micro treasuries. So maybe not with the 10-year, because probably not even with the 10-year and the 30-year, because this 10-year is actually a 7-year and this 30-year is actually like a 25-year. and these interest rates are a little bit different. But probably with the 5-year and the 2-year, you could probably get away with it, right? So if I see the 5-year tick down, if I see the ZF tick down, then I should see 5-year tick up. And I could actually come in and I could calculate based on what this price is and the difference between the on the run and the cheapest to deliver treasury. And I know I'm using a lot of terms, but the CME has some webinars that you can go back and watch where they give an introduction to the treasuries where they explain these terms, okay? But I could come in and I could see, I would need to calculate the difference between the on the run, that's like the most recently issued treasury 5-year, what the interest rate is for that. And in the 5-year, there's a range of treasuries that can actually be delivered. And one of those is cheaper to deliver than the others. And the cheapest to deliver is the one that the 5-year actually trades off of. So if you know the difference between the on the run and the cheapest to deliver, then you should be able to take the price here in the 5-year and calculate what the interest rate in the 5-year down here should be. And if they're not in line, then you would put a limit order out there to say, okay, yes, we're trending up here in the treasury. So if anybody tries to sell it at a price that is out of line with what the 5-year over here has, then I'm willing to take those fills. And then I will just put my take profit on the other side of the spread. And if we tick up here, then I'll just move my order based off of what it's doing, right? And that is arbitrage, right? I'm market making based on arbitrage. Okay. Maybe a more simple example. We can do this over here in just the regular treasuries, right? So I should expect to see certain amounts of like spreading activity, yes, but sometimes you will see order flow that will come into these that it simply isn't in line with what's going on. So right here at 27 3/4, maybe a good example. Okay. They might be able to bust through that. That would be one tick lower than the 10 and the 30 went. Okay. But what if people are pushing into 27.5? They're pushing 2 ticks beyond what these other would take, right? Then I'm totally willing to take that fill. As long as I'm not seeing flow in the others as well, totally willing to take that fill. Because the chances are that it flips back up, right? So if you guys have ever seen me take these 1 tickers, that's often how I'm doing it. So in this situation, I mean, it's slow. Another thing that you want to factor into when you're doing that kind of arbitrage is like how much flow are we seeing? Like if I want to get filled at 17.5 and take profit at 17, since there's 1,700 contracts at 17, I would like to see enough volume coming in short that getting filled at 17 is a possibility within a reasonable time frame. Now that could pull back to 500, but in this situation with the 1,700, I'm going to guess that at least 1,700 trade there. So if I'm not getting 1,700 contracts over the last minute or two, then it's probably not a good trade just because I'm not getting the volume, right? Okay, so it ticked up. But that's how you do that sort of a thing. So you want to have enough volume coming through, and you want to take a fill based on arbitraging another instrument that should follow it pretty closely. So here between the 5 and the 5 micros is a really good spot to do it. Probably would want to write a robot to do that, but hey, you could do it. But what we can do as humans is we can try and do one that's a little bit more sophisticated. For instance, like with the spreads, like what I just explained. Or we could try and do one based off of a correlation with the 6J and the dollar index would be another good one, right? If the 6J is heading down, I think roughly it is heading down. I'm seeing some long order flow coming into here, and I'm not seeing it happen in the 6J. Then based on that correlation, hey, I'll take the fills, right? Or you can do what I do and you kind of look for the liquidity holes. And because if you're in a liquidity hole, the school is calling us again because they're doing late start. If we're in a liquidity hole, then I know that like if they tick up, that a lot of that volume is going to cancel, and so I'll still be able to get the easy fill. I wish I could be like way more specific for you guys. I wish I could list out, okay, here's the trade, X, X, X. These things are fit, and then you can do it. But it really doesn't work that way. I'm trying to give you more like general principles. Like, okay, if you were going to take an arbitrage trade, like how would you go about doing it? And then probably what you should do is then based off of those things, then you start trading it and testing it and optimizing your trade based off of what you learned from that. So 16 half poles. Okay, so I said I would expect probably 1700 to trade there at 17, and they didn't. They're only 950. Well, 1351, but there was like 300 contracts there before. So they just traded through that. Now, where is that coming from? So doesn't see the 6J move. I'm seeing oil move a little bit. Oil's moving a little bit at the moment. That could be could be a factor. I didn't hear any news. That was a pretty strong move there. And okay, so now you can see at 16 and 15 half with a little bit more volume trade there, right? The last ticks through were 1400 and 1300, and overall 2000 have traded through there. So there's a little bit more volume there. 138.12 down below us has some volume at it. And you know, I have a little note there that last time we were at 130.12, that was when the interest rate in the 10-year was 1.5. So maybe they're heading to that. Oh, this is that's curious. That, and okay, now look at that. You see that iceberg at 14 half? Oh man, I'll show you and take that one. This is a sim trade. No, 27 in line. It'll be close. No, they're going to leave me behind. Should have clicked a little faster. Come on, 26 more. Nope. Okay, so if I had clicked just a split second faster there, I would have gotten filled at 14.5, and I could have been taking 14 or 13.5 right now, right? So in a trend, if you see an iceberg right next to the high or the low. And you're getting strong trending order flow. And you're in a context where a trending day makes sense. Take that one every time, man. Take that one every time. How can you learn all about icebergs and orders? So I talk about icebergs I have a video on my channel about icebergs and catching the edge. So you should go watch that first. And then if there are things that you don't understand about the video, go into the comments on the video and ask me in the comments. And that might give me some ideas of like how I can make a more informative video to answer your question. Look at that. Pick it in favor. So do you see there's 3, 2, 1 here? Let me highlight it. So you see right there that 3, 2, 1, 9. Let me try again. Do you see it now? Now that I've highlighted it. So the low of the day was 14, and there was an iceberg, 3,000 contracts absorbed at 14.5. And we had come down to that location very quickly. Okay, so what does that tell you? There is somebody that's selling and they have an iceberg and they're following the iceberg down. So if they get any backwash, they're 100% willing to take the fills. And then what should you expect to see happen? Because when they do that, they're trying to coerce robots to buy into them, right? So they take all of the fills there and then they pull 14, 13.5, 13. That was a pretty big one, right? Because then they know that all of the guys that just bought there are going to puke into them and sell into them, and then they can take their profits there. So this is a trade that in normal circumstances is a 50-50. But if you're getting strong trend, take it every time. If you're getting strong trend, take it every time. It is the best. It is the most fun trade. I'm still going to take the fill if they give it to me. Now there's an iceberg right there at 14. Yeah, this is curious. And the E-mini is open now as well. So far, well, first impulse. The volume on the open was a sell, but the first impulse is ending up being a buy. So what's that mean? I really want to know what happened there. Something happened there. There was probably some news in the treasury market that our news squawk is not picking up and that we're not seeing on Twitter, but was maybe specific to the treasury market. Okay. Well, what just happened there at 13.5 maybe makes this fill at 14 a little bit more risky, because I would prefer to get the easy fill at 14 and then them pull and get an easy fill at 13.5, right? Okay. Okay, so there's the sellers in ES seem to be winning so far. Your Q in 14.5 is so close. I would pull 14 and just accept it if it doesn't tick there. Yeah. You know what though? It looks like they may be forming a little bit of a range here, so probably we'll have multiple opportunities to catch it. There you go. They gave us 14. And they give me 13.5 now. The thing I was worried about more, the thing I'm going to be worried about more there is like 14.5 pulls. They fill me and then they tick through me a little bit. I puke and then they push back down to the lows. That can happen to you, but yeah, both of those orders I got filled and I took a winner off of. It was only 1 tick each. So 2 ticks total off of that, but still. I was only doing that to just show you. So you want to go through the framework. You want to say, okay, what are expected flows that we could see? What is the order flow that we're seeing right now? What conditions is that leading to? Okay, so what kind of flows do we expect to see? The big expected flow that I could potentially see is selling in the treasuries in anticipation of the Federal Reserve decision today. Okay, so we're looking for some selling. We're seeing some after, and then there was the news. So after seeing the news flow, the retail sells, then we started to see that selling after that had all calmed down, which was kind of the scenario we're walking through right now. So we have the expected flow. We can see the flow. Now, what kind of conditions do we have here in the order book that's leading to? Well, it's leading to some situation where the bids are extremely weak. Like they are pulling and they are just smashing through them in some instances. They traded from 18 or so down to 13. So a solid 10 ticks down. Just like that. It was so fast, right? Very fast for the 10-year. Now that we're in the 14 to 12 area, the market makers are picking up a little bit more volume though. Okay. So that's good. But let's just note this order book can pull on us really quickly, is at least on the bids. So that could well be because the market makers know that there's a possibility of that selling volume coming in and they don't want to take the fills against it, right? And now we can utilize that in our trade. So if I want to, we may be forming a hole here at 13. It didn't like happen quickly right away, but we are trading some volume there. It is kind of rotating there. So I'm going to say, well, and they've traded 10,000 contracts at 13 now. So there is a hole. The only thing that's kind of giving me pause on that is 12, right? Because we know that 12 is a big deal. There's a big order there for starters, and it's where in the past, at least with the 10-year, that ended up being at 1.5. So looks like they're gonna have to move up a little bit more for it to be 1.5. But we'll cross that bridge when we come to it. But if I missed that move, I probably not going to be trying to sell at 13, right? Unless it shows me another really strong order flow setup, like like they come to 12.5 and I start seeing iceberging there and they smash through 12. You could potentially put a market sell order at 12, and if they smash through that, hit into it. But I've got to be careful because it may be possible. Like we should, in particular, we want to be worried about limit orders canceling. And if limit sell orders cancel. Okay, so there was some limit sell orders at 13.5. When we ticked up there, they moved to 14. So I'm still not sure. What would really concern me is like that completely pulls and then they kind of get sucked back up across this chasm a little bit. For the moment, though, I'm not seeing very many market orders hitting into 13.5 anyways. I should note, by the way, that the Treasury does not seem to be reacting very much to what's going on in the ES right now. Although the ES, while down, is a lot more constrained in the first 10 minutes than it has been earlier in the week. All of the other days this week, we would have been, busting the high and deciding whether it was going to be a strong uptrend or a strong downtrend by now, right? So something I'm noting interesting here is that I am seeing some liquidity get added on the books in here, right? Like they're putting like almost 4,000 down at these prices now. I really wish, man, when did that occur? 7:26. So almost 15 minutes ago. The only thing I was seeing around that time was something about oil. Oil is kind of moving right now. Moody's global oil prices will remain higher than the midpoint of our $50 to $70 barrel range medium term period. And then Biden tweeted nonsense. The SEC will tighten insider trading laws and propose modifications to money market funds. Great British Pound back above 200-hour moving average, says Forex Live. Were we seeing some dollar movement there? Actually, yes, we did. Okay. So it could have been a currency flow. It wasn't the 6J, was it? The British Pound. It was. The British Pound and the Swissy both kind of fall in there. And the Euro is falling, but not strongly. So I think that might have been from a headline in the UK. At least that's what our correlations suggest might be happening. It does look like they're going to flip back here. And the 30-year, oh, they're flattening, man. The 30-year is coming back up more than the others. They're flattening. So that means that we're probably better off being in the 5-year here, huh? That's curious. I don't know. Okay, so we did kind of get sucked back up because that move was so fast, right? I should note that at least in the 10-year, that the volume on this pullback was stronger than the volume on the downturn. There could be some spreading, but I'm not sure what to make of that, actually. Well, and the E-mini is still looking pretty ugly at the moment. Let's just kind of see. Like, they were able to push all the way back up to 15. I have to see, like, if it's a reversal, then they're going to push back across this chasm and back to 19, right? But if it's not, then they're just going to slowly settle back at 13, and then maybe another leg of the order happens, right? The volume, though, is not that. Volume is not kind of what I expected to see. The more buying in the 30-year there. So that is not in line. And I'm thinking to myself, is that enough of an aberration to get out or not? I think that move was driven by the Great British Pound. I just don't. The way that it happened kind of suggests news, but like I only see one tweet about it, and they're just talking about technicals. So I don't know. Yeah, okay, so 15 is not particularly reliable price. That one might actually be worth buying because you see the 10 moving down and the 5 and the 30 not. Oh man. Okay, so at 7:25, when that move happened, Zero Hedge posted a story. Inflation is a choice for which the Fed is chiefly responsible, says Kevin Warsh. In a Wall Street Journal op-ed, the former Fed governor says the Fed is the main inflation culprit, and he put his own emphasis in there. I'm not going to read the whole thing. Yeah, okay. I don't know if that had anything to do with it, but that is curious timing. Quite a bit trading there at 26 in the 5-year. E-mini may be turning up. They're making a good attempt, at least. Reset that. A little bit more selling there. Okay, but to the question that we were asking ourselves earlier, right? Like what the conditions are. Okay, the conditions are this is slippery, man. Though what you're seeing on the DOM here, not particularly reliable because when they came up, there was some big orders and they just moved out of the way. So it's slippery on both sides. Which means you're going to get deeper than usual pullbacks. If this is like a meta order selling, and I don't know, the way that kind of happened kind of makes me think that the move that we just got was not part of the meta order that I was expecting, was more likely to be a correlation or a news event. But if we are getting a meta order, the pullbacks are probably going to be deeper than normal. Now, the other side of that is that if I really want to be short treasuries, they're probably giving you a pretty good spot to try and do it right now, huh? Though that tick right there kind of makes you wonder, right? Okay, so now some icebergs on the other side here. Oh, I'm surprised that at the height of that it was 482. Okay. Well, that doesn't look particularly good either. It really sucks being at the front of the queue and you didn't get filled. That probably means that you're not going to get filled. They're going to fill that entire gap. Well, now we did get business inventories. Top of the hour, right? Business inventories 1.1. Housing market index 84. And then at the bottom of the hour, there's gasoline and crude oil inventories. Yeah, it's still ticking up there. Very curious. Now, the British pound continues to fall. I am seeing some flight into the Japanese yen, though. Okay, well, back to the scene of the crime. I kind of thought, with as aggressive as that was in the situation, that had to have been somebody like really selling it, you know? But it looks like I'm just going to give that whole thing up. Somebody was totally willing to take me there. That sucks. Well, when it was back up here, I could have sold into it to get out, but it's okay. Nothing lost. With it trading that way, though, if they get back above the open, then that kind of puts us back into what I was what I was worried about, which is that you just get a mess that is impossible to trade, you know? And especially with the book being the way that it is, I mean, they're thickening up a little bit. It's better than it was, but means that the excursion that you can get is ick. Another thing is that the spread is not working in my favor, right? Yeah, because this is the spot where I kind of had some profits, but because the 30-year came up so hard, 30-year not in my favor. Oh, and the E-mini did move a little bit lower there, by the way. They did not, in the end, dig themselves out of that hole there. This still kind of looks like they're trying, but the volume is net sell so far. Okay, what time does the Fed happen? It happens at 2 o'clock Eastern time. There will be a press release with the statement, and then 30 minutes later, there will be a press conference that tends to go for an hour, hour and a half. So now that they've scared me out, are they going to shove back down now? Well, I know this game. I really don't want to play it. So in this one, I don't, from a technical perspective, they're saying, okay, is this a pullback and push higher? Or is this retest of the lows? Is your style to scout for a few ticks each trade? It just kind of depends, man. I haven't been incredibly consistent on that. I like my risk reward ratio to be over 1. I usually get 1.5 to 2. Lately I've been closer to 2. But I'm kind of trying to use the order flow to kind of, make my decisions. So do you see there how there was a really difficult call there, and I made the right call, but I was not really able to execute on it, right? So it came down and it came up there, and I said, well, this flow in the 10-year is not in line with what I'm expecting to see. So then I tried getting out at 10, and it didn't give it to me, and so I just kind of let it come back. But there does kind of the thing is like, if I catch one and it goes a little bit for me and I see the hole or whatever the deal is, or I start to see contrary order flow, then I typically want to get out unless I'm really trying to swing it. But when I've been trying to swing it, I've made a lot of mistakes doing that. So I don't know. Noticing here and lately, it's been hard to get more than 20. Like I probably could have just had my take profit at 20 ticks and I would have been really happy with it, right? But I think that the bigger thing here is that I was saying to myself, I don't really want to trade today unless I really start seeing like the sell, right? Because they have pulled back in the way that they have. That makes me much less interested in trading it. That means that the scenario that I had planned out really isn't actually happening. That something else happened. We still don't know what it was, but something else happened that fooled me into thinking that was the flow. So I thought that it was people selling for the FOMC, and it was probably just some currency move in the Great British Pound. That very quickly reversed, by the way. Oh, did it quickly reverse? I wonder here. Yeah, I'm not quite sure what to make of that. Well, we got some news in 2 minutes, right? So. But, typically, I'm gonna let it go as far as it can go. When we started to see more than 10K taken, at 13, and I'm not looking to swing it, I should be taking it off there. I was looking to swing it, otherwise I would have taken it off there. Is my answer to that question. I know it might not necessarily be the answer that you want, but you just got to think about it like, does the market care that I want it to go 10 ticks in my favor and for it to not go 5 ticks against me? Market doesn't care. Doesn't matter. All that the reason it moves is because of what the orders are doing. Right now, there's some buying coming into the 10-year, man. Well, it's coming in across the board, but it's most prominently coming in the 10-year. It's weird. But that's why it's moving the way it is. And that doesn't have anything to do with where my stop is. So to me, trying to set a stop and target based on that sort of thing is kind of a little sketchy. It's going to give you what it's going to give you, and you have to be fast enough to realize what's happening and take it off. And that one I didn't take it, but then because I was okay with a pullback, right? But by the time that I realized it was no longer a pullback, they weren't going to fill my limit order. But that'll happen to you sometimes. I guess I tell you, one of the mistakes I've made though is that one will happen, and then it will go back to my entry. And I'll say, no, we'll give it a little bit more room still. Like we'll still let it go against me. And I think in this kind of situation, like the trade has been invalidated, even if they start trading back down. Like you saw there when they kind of started to take a look, and I was like, okay, maybe we could try taking it again. And it went right back up. So I know the game that they're playing here. And I don't necessarily want to be playing with them now. Like if they had come in and the market was 100%, we're going to sell this because we know that the Federal Reserve is going to raise rates and everything, then fine. But now I'm coming in and I'm seeing somebody buying it too, then that leads to the absolute mess that I would prefer not to toy with. Because that's going to be an account destroying mess when the Federal Reserve opens up or when they make their decision. Oh man, it's going to be it's going to be something. So off of that flow, is someone making a dovish bet? Or are they just retracing that move? You're in the DAX, you're saying you're seeing some monster sales programs? Oh, the E-mini has been selling pretty hard today too, right? 6,000 contracts net sell. Decent. They're still trying. When they touched those lows there, it's like you getting the rebound volume really hard there. Yeah, so this is turning into a volatile mess. I've never seen a scalper make money with exact targets and stops, so your answer makes sense, yeah. So first of all, I would be so you kind of have to realize that a lot of where the edge is coming from is just like the ability to manage, take on and then manage the risk, right? Like over here in the micros, of course I have a stop, but I don't necessarily have to put a stop out there and have it be close or anything like that, because the amount that's actually being risked is very, very small. Once I size up, then I have to be a little bit more picky, right? So my ability to just take something in there and let it go against me a little bit helps a lot, right? And I suspect that that's a lot of what FT is doing too, right? He kind of scales in and scales out, and he'll scalp the range too. Yeah, I've heard that name before, but I haven't seen that. But the other thing is that they may be incorporating informational edge into the way that they're trading a lot more than they realize. Yeah. So I really, it was because you said they trade what they see. That's a phrase that I really hate. Because what you see, not reliable. not reliable and very necessarily predictive. What I want to see, what I want to be doing is I want to predict what the order flow is seeing, take a trade, and then see that order flow come through and confirm, right? That's kind of where I think you can get a lot of edge from it, because I can predict what the order flow is, get into the trade, and then when I see something that is not what I expected, I just get out, right? And if I really, really understand that market, when you're right, you'll be right, and you'll know exactly why it's doing what it's doing and how it's going to play out, right? So that allows you to be picky, to be on a hair trigger and say, well, this isn't in line, so I need to scratch it, right? This one was a rare, well, it wasn't rare, but it was kind of an unusual situation, right? Because that was what I was expecting to see. It was much better than what I expected to see. Oh, okay, they're going to push back to 1.5 in the 10-year. And then wait a little while, kind of realize, okay, that's not right. Can I get out? I can't get out. It's fine. I should have executed that a little better on the exit, but not much I can do about that one, unfortunately. Just dipped in some oil majors. Well, we did see after that Moody's report and everything a little bit of man, so is my financial juice even working? Because I did not hear the business inventory is number one spot too. So business inventories was not interesting. Neither was the housing market index. So now we got crude oil inventories at the bottom of the hour. That should be interesting for them. Anyways, don't trade what you see. Predict. By the time you see it, it's too late, right? And if you're not predicting, then you realize that you're trading on noise. You're a noise trader, and if you're a noise trader, then your primary edge is actually just your ability to take on risk. Would you know why the ES and the MES do not move simultaneously? I mean, they pretty damn close, man. So I did some studies about this, and I went and I looked at the spread between the two of them, and there's a gap between them. There's a gap between them that you could probably arbitrage. that even a retail trader could probably arbitrage, but it's not very much. It's not very much. It's all like maybe a point. Maybe a point that on average. Ultimately, though, they're both arbitraging off the index. Yeah, they do. Now, when you're watching my DOM, one of the things that I did is because the ES moves so much, I told my MES DOM to not auto center. The ES one auto centers, but the MES one doesn't. So they might look out of sync, but I mean, look at it right now. They trade almost tick for tick. And when they're out of line with each other, it's usually because of the one or side or the other is experiencing a stop run. I wish I could remember the indicator that I did that with. Maybe it was just a spread. We could do it with just a spread. I will demonstrate. Put in ES. I will go on a 5-second range. Okay. And then I'm going to come in and I'm going to put my spread candles on it. And the ratio is just going to be ES, MES. Okay. Calculating. So here you can kind of see when it splits out of that, that's when the spread is more than just a tick. So you can see there's differences of about a tick in some places, but overall they're pretty damn close. Overall, they're pretty darn close. Oh, by the way, 10-year back above the open. I don't even know if there's anything fundamental about why the treasuries hit back so hard other than somebody like taking advantage of all the people that were short or something. What a mess. Yeah, like the funny thing about I've seen some videos where he talks about scalping and how he's using the order book, and he didn't really explain anything about what he's seeing in the order book at all. So it was like he didn't understand it enough to know why he was doing what he was doing almost, which I think is going to be really, really common with order book traders. Like it's like a machine learning thing, and I can't quite put a finger on it on what it is that I see. And the thing that will screw order flow trader up the most is when the flow just straight up changes on you. Like this move back up was a really good example. Like the whole book changed. That wasn't unusual because I remember I noted saying, well, it looks like the liquidity is firming up here a little bit now. So like a large player got involved and pushed it back up. Was a very big change, and I didn't adjust to it very quickly. So with a futures trader, because he has the whole thing about You take 3 contracts, and these are the legs that you take on the contracts and everything else like that. So I went and I made a spreadsheet to kind of like try and show what the longer run stats for break even would be on each contract. And I showed it to him, and his response back was like, what are those percentages though? Because my traders almost always beat that percentage. And well, that percentage was based on random, based on an efficient market, that should be break even. So we should assume an efficient market, and that's what your win rate will come out to. And if your win rate is higher than that, then you have some sort of an edge. But the problem is you can't just come in and say, well, on a monthly basis, my traders almost always hit this number, because there's a fat-tailed nature to it, right? When it stops working, it's like it's not going to work very well. It's going to be like this one bad day. And so you're going to say, oh, okay, we tend to hit this number. Yeah, until the day that you blow out, and then you're not hitting that number anymore, right? Most of the time it'll be above it until the one day when you hit the fat tail, right? So I keep trying to get at like where can we sort out how much edge what FT does actually has, and we don't really have enough information. I suspect that a lot of it has to do with the managing the risk, because the kind of stats that they're looking at aren't really very predictive setups from my own testing. But then, like I said, sometimes you just get on the order book and it's just like every tiny little thing that's going to happen. And hey, if we were getting a meta order and the market was all agreed that we were going to sell and there was going to be continuation on that meta order, then you really would have been like, wow, you called like every pullback and how far it was going to go and everything, right? I mean, I need to blow my nose. Hold on. Anyways, it kind of comes back to this main argument of mine, right? There's so much noise out there in retail trading, man. Everybody you talk to has some idea about how you should trade, and you yourself, how do you decide how you're going to trade? Why is it if you're using a moving average, or there's a certain moving average that you're using, or you really like the stat that we tend to extend the overnight high and low 80% of the time, or whatever it is that you're using? Like, why did you center in on that particular thing and focus on that particular thing? And are you focusing down a road that is ultimately going to lead to nothing, that it has no edge in it, and you just wasted all of your time? Because for 95% of traders, that's what the case is that you're just wasting your time. Well, some people, the natural human inclination is to go and find a person that seems to be doing it really well and trying to copy what that person is doing. And there's a lot of problems with doing that. The biggest problem that we have on that one is that you never get enough information from those people to really see how they're doing, right? Like, FT doesn't post a track record. And he, why? It's because he knows better. Like, he's a registered principal and all of these other sorts of things. So if he started posting his track performance, even if it was really good, it would probably become a problem at some point. And so you just don't show it, right? So can we even know, how their strategy performs and if it's appropriate for me or not? Like, no, you can't. And the other problem is that you might see stats, but you might not understand the statistics behind it well enough to realize how consistent it's going to be. Because what a lot of people do is they'll say, oh, it traded really well for a month, and then they go and try and trade it, and the next month they blow out, right? And then maybe they can do it and you can't. Maybe they have some abilities that you don't have, or some advantages that you don't have, right? So, and then the really big problem is that for any kind of individual edge, there is a limited amount of money that can be made from it. There's an optimal number of contracts that can be traded on it. And if you trade more than that optimal number of contracts, then it's not going to work anymore. So if there's a strategy out there that really is like truly successful, then a bunch of people are going to start trading it. It's going to disappear very quickly. I mean, like if it really, really, truly works, I mean, this is a consistent thing. You can make money from it every day. All you got to do is just follow this one thing, man. It's not going to last for very long. And you got to know this. It's not going to last for very long if it's public and it's purely statistical, right? So, trying to follow other people, it doesn't work. So what do you do? Well, I say that you need to take a scientific approach. You need to go and form a theory about the way that the market works or the way that the market behaves, and then find a way of testing that theory against actual market action and show it over a large enough data set and a wide enough array of conditions and so forth to prove conclusively that that behavior really is a thing. Scientific method, empirical evidence, right? So this is where I come down to, there are people at the universities, the best universities in the world, that have spent their lives studying this stuff. It's called market microstructure. And they have found a couple of things about market microstructure that is very interesting. One of the things is the thing that we just told you, that orders have impact, and therefore if there's a statistical inefficiency in the flow, it gets arbitraged out very easily and quickly. But the other thing that they've found is that there are these large institutions that are so big, anything that they do comes in and has an impact on the price. And they could be doing something that has absolutely nothing to do with what's going on in the market. Like, they just need to rebalance their portfolio. There's no informational content in that at all. And when they come in and they do that, it will move the price of the thing, and it's long lasting. Like, once it gets up there, like, the market has a memory and it remembers it. So what does the net effect of all of those, big funds doing all that stuff all the time do? It makes it so that it's practically impossible for the markets to be informationally efficient. That means that the markets today could know with 100% certainty what the Federal Reserve is going to say in their statement. And I think we have a pretty darn good idea. It is going to be an increase in the pace of the taper and 2 interest rate hikes next year. If that's not the case in the statement, it would be a really big surprise to the markets, okay? Like, we know what's going to happen. And yet, when the statement comes out, even if it's mostly expected, you're going to see a ton of volume. You're going to see a ton of volume because the market cannot efficiently price that stuff in beforehand. And once the statement comes out, the orders are going to come one way or another. Right? So, this is a conclusion. This is I think that this is a really key thing that retail traders can use and understand. What does it mean? It means that it's going to be easier to pull edge out of an informational inefficiency than it is out of a statistical one. You have to be fast. It's a different game. There's other problems with it, but there's getting more edge available on informational inefficiency than there is statistical inefficiency. Right? So that's my case. That's my case. And this is all backed up with decades of empirical research. Right? Doesn't necessarily mean that you're going to make money off of it. It's still going to be crazy hard. But at least you know that you are learning and going down a path that isn't a waste of time. Right? That isn't just noise. So how do you know that it's noise or not? You're saying, I really like FT71. I've spoken to him personally before. He's a really nice guy. He knows a lot about trading. He has like daily statistics on volume profile tendencies that are real statistics. But trying to attach that to a stop for a reasonable stop for a retail trader is crazy hard. And I've tried back testing that. I can't get it to work. So as far as I know, if he's making money, it could be noise. There's no way for me to know or not, right? That's not like a bash on him or anything, right? It's just, it's an honest assessment of how you have to approach trading. You can't approach trading with the, I'm just going to follow this one guy, right? And it's the same thing with me. But with me, it's even easier because I just straight up tell you, I did awful last week, right? Don't follow me. Don't take the trades that I take. Do better than me. It may well be the case that I never really make significant amounts of money from doing this. It's not even like may well be the case. It's probably the most likely scenario. We're talking about Futures Trader 71. He has a YouTube channel. So what he does, I'll explain. I'll show you here. I'll do an FT71. Although I'm sure that my explanation is going to be like completely off from his, because I tell you what, he has some stats, and I have the same sort of stats, and I have even more than what he's got, or at least what he's talked about publicly. And I still will watch his scenarios, and I have no clue where he's pulling this stuff out from. Hold on a second. The new Squawk is talking about the crude oil. So what he'll do is he'll come in and we'll look at the volume profile, right? And we'll say, okay, well, let's do this before the open. So let's just, okay, there we go. So we come in at FT71 and he's going to say, oh, we are right at yesterday's point of control. You see, here's yesterday's point of control. Here's where we are at. So scenario one is going to be that there is going to be a move. I'm going to do this. So, let me change a few things here on the chart. Right side margin, maybe make that more like 500. So I have room to like draw. Okay. So scenario one is going to be that they're going to push to the low of the day and then extend down. Actually, let's go like way wider out so that we can look at these numbers. Okay. Scenario one is that they're going to push down and they're going to extend things to the where we were at the non-farms and maybe to 45.60 and then bounce, and we'll see. The other scenario is that they come to yesterday's low. So that's one. Yesterday's low and bounce. That's two. And scenario three is that they will stay within this range from here to here until the FOMC, and then we'll have a breakout either way. Okay. And that would be, it would list out those three scenarios. Okay. Well, what have we gotten so far? So scenario 2 where we went down. Actually, all 3 scenarios are still in play right now. All 3 scenarios are still in play right now. But then what he'll do, or what he says he does, is then he'll come over here in the E-mini and he'll look at like, okay, what's it doing? Like, am I seeing buying down in here in the order flow? That means that we're going to get either scenario 2 or 3, right? And he trades it that way. But the things that he says about his scenarios supposedly come from stats, right? So now let me back up. This is what I think, and I think that if he looked into it long enough, that I could maybe convince him to change it. Okay. Here's what I think you should do. You should say, what are the flows that we're going to see today? What are the flows that we can see today? Well, number 1 is FOMC bets, right? People are going to come in and they're going to take trades based on what might happen for the FOMC, okay? Scenario 2, Omicron panic. Oh, by the way, this up here, we should say sell these, okay? Omicron panic. Buy these, right? Sell ES. Next flow that I think I need to be aware of here is gamma hedging to 4,600. Okay. Then the next one is right. What else should we be factoring in here? There was some supposedly come from stats. Yeah, so oh wait, hold on, gas is going on here. Let's see. They're moving back to 70 in oil. Okay, so anyways, the way that he generates these statistics is he has all of the information about like what the point of control and value area high and value area low and high and low and overnight high and low and regular session high and low in a spreadsheet, and then he generates the statistics off of that. Robinhood reported that its average customer is 31 years old and has a median account balance of $240. Really? I didn't realize it was that bad. Okay, anyways, back over here. Right, so I'm going to look at all of these flows that I'm seeing, that I expect to see for the day, okay? But then the approach is kind of similar, right? I'm predicting the future flows that I'm going to see, and based off of all of this, I'm going to set up a scenario. So what is my scenario? Sell ZN. That's my trade. I could have 2 or 3 different ones, but in this situation, the only thing that I'm interested in doing is selling ZN, right? So now we come in and we trade it. Oh wait, minimize. And we expand the ZN chart. And let's come back over to here. So the first, there's also the news. That's the one that I'm missing on that list. The other one that I need to put at the top of that list is retail sales. Okay, so we see retail sales. We didn't actually see much happen off of that. And then after retail sales, we started selling. So what that says to me right there is retail sales happened, and they weren't too interested in doing anything. They weren't too interested in trading because of the retail sales. The retail sales didn't give anything that really changed anything for them, right? So now they're going to start trading based off of the next flows, right? So now that one's out of the way, now we have an opportunity to sell ZN. And what are we seeing? we are seeing a decline in cumulative delta in this yen. So that says to us that we are seeing some active market selling after this news. Okay. So if our prediction is that we're going to sell yen and that's going to be the most dominant flow today, then we go in and we sell. Okay. And now it moves down and we come into a liquidity hole at 19. Okay. So a liquidity hole at 19, that's expected because now we start going into when we're seeing a flow, what should we expect to see? We should see a meta order that goes until we form a liquidity bubble, pulls back, pushes down again. Oh my gosh, look at my main screen. What the hell? That was weird. When I was doing that, it screwed up my screen. Okay, we're going to see something like this. Okay. So there was the first leg and the pullback, right? The liquidity hole. Cool. So now we should see the next leg, right? The next leg. Da-da-da. There's the next leg. Awesome. So we were right. Now this was really fast. Now what are we seeing? Cumulative delta actually rising there much more significantly than any of that selling. Okay. So we do have a hole. So we're getting this. We are here. We are getting a hole, but I'm seeing delta rising on there, which is not consistent with we're having a large meta order and there's going to be a third leg, right? So now at this point, we have to say, okay, something's wrong. Maybe we want to get out because it's not trading the way that we want it to. And we tried to get out and it came back up a little bit too quickly for us, right? But that's how we trade it. And that's the process, right? Set up, look at all of the different flows that you can expect or predict that could potentially happen that day. Make decisions on what the plays that you want to make are, and then take your trade using the order flow to take an optimal entry, and then watch the flow. And if the flow is not consistent with the flows that you have laid out, then get out. And if they are, stay in until it stops. Or, you see what you want to see. I think the baby is still sleeping, but I think one of the girls is like in her bedroom singing or something. Place a trade and pray for your life, right? Yep. My strategy is buy it and hope you got a good spot. Right. Which is kind of really is what I do because I'm speculating, right? I am making a bet that I'm going to see certain action based on informational knowledge that I have that predicts order flows. Because what the current price is and what the price was yesterday and what price the most of the volume happened at yesterday has almost nothing to do with what the future orders are going to be. At least from the research that I've done, they don't. So I ignore them. But I think if with a little bit more detailed analysis, we probably could sort some of that out a little bit and put more work into refining the flows that we expect to see. What was your score the last 6 weeks? If I was to go and look at my score the last 6 weeks, the stats wouldn't be very useful to you because I've just taken so many awful trades, dude. I really screwed up on a trade or two. And let's see if I can. I was doing okay until. So I'll just go to the beginning of November if that's okay. Yeah. So there's just this one period where I lost so much on both live and sim. We could limit it to these guys. Should still see some bad, yeah. Like I was doing really good. And then this day I had a runner. Oh my gosh. This day I had this runner that was doing so good, and then it came back on me. And then this day I just did something stupid. Before that, if you go back further, if you go back to August, before that, I was doing pretty darn good. I had like one screw up here on a spread trade that I shouldn't have taken, but then from here to here, I was doing really great. And then this volatility just killed me, man. This also was like me taking on. I had sized up. Like I started sizing up here, and then it started doing badly. You say win 66%? No way. Oh, that's like so hard. Okay, so with these stats now after those dismal trades, so let's come back and just like remove December from the picture, okay? What's the best way to do that? Second through the 20. Oh, no. God damn it. I'm going second through November 24th. Okay. Actually, let's just look at the good. Oh, well, here we can just only look at 10-year trades. That's what we want to do there. Okay. Now when I look at the stats, 42% winners, but actually kind of went down. At one point, I was getting like 20 MFE. It was like really good. The way that we're trading, if you're hitting 66%, you're doing something weird. You're getting unusual stats. I don't think I've ever seen somebody over a 6-month period get 66, even over 50% with a risk reward ratio over 1. I don't think I've ever seen somebody show me that. Those numbers are unrealistic, I think. And certainly not with the way that I trade. With the way that I trade, if you're getting over 50%, your risk reward is going to be 1.5 to 2. And you want your win rate to be around 45. And anything above 45 is like rock star, or the market's being really nice to you. By the way, we getting a little bit of selling here? Just a tad. Just a tad. So I think that I'm looking at this. I'm not seeing enough information to think that there is a large meta order buying and that we're going to flip back up. Instead, what I see was overextension on the downside and all of the shorts getting stopped out. Wonder why YouTube doesn't allow you to post pictures and think, oh, wow, you realize how big of a mess that would be. Everybody would post porn, dude. You're full of shit. Wait, when you say 3 to 2, so you mean that you win 3 for every 2 you lose? Like you'll make 3 points and you'll lose 2 points. And your win rate is 55 to 60%, and for the last 3 months is 70, I call cap. You have to show me pictures to prove that one, dude. I suppose if you've got like an arbitrage strategy, that might be realistic. Those might be realistic numbers. if your risk reward is actually the opposite. If you're actually risking 3 and making 2, then those numbers might be realistic. If your stop is larger than your target, then you could hit those numbers. But if they're not, then you're either misinterpreting your numbers or you're lying. Or I'm going to be really, really impressed when you show me the broker statements. Like, I don't just say this, make this stuff up. Like, of course, I know how I tend to perform over time, and usually I hit around 45%. But a lot of people have shown me stats, man. A lot of people have shown me stats. I have looked at a lot of strategies and that Ninja Trader performance window, I've spent a lot of time looking at those. If your average winner is larger than your average loser and you're getting anything over 50%, you're probably doing something sketch. So it never works that way. Okay. So Kyle says I was able to achieve an R factor of 10 with 35% accuracy in some months. That is realistic and really good. Yeah. You'd have to be selective to get that, though. Yeah. I think the issue with a strategy like that would be that you wouldn't be able to take very many trades. No, 10R with 35% is doable. So if you're getting 10R, you're probably going to be more in like the 10 to 20% range. Well, 10 to 25% range. But 35% accuracy could totally be possible if you really have something that is truly predictive, right? Even though I just go flip-flop with it and that's why I have big drawdowns. Okay. I don't understand that, but if you're doing that, what should happen is you should have like a big win, and then it's going to be little losers and big win, right? You should never have a big down day if you're doing that. Unless you really do get a day where you just like lose 20 times in a row, which is possible, but I would think that you would be that you'd be being selective and wouldn't take that many trades in a day. 15 to 20 trades in a month there. That might be doable. Another thing that you could be doing is you could be swinging, right? So if you are taking swing trades and you're swinging the S&P 500 and you have a really, really wide stop, then you could maybe get those kinds of stats. But if you're doing intraday trading, hell no. Well, the ES has recovered a bit. They're kind of turning back down at the moment. The treasuries, they've fallen back a clip, but now they're just kind of like, I don't know, they don't seem to be doing anything. Big down days, small losers, but lose 20 times. Yeah, but if you're trading that type of a strategy, you shouldn't be doing that, right? You're trading that kind of a strategy and you lost like 3 or 4 times in a row that day, you should probably just quit. Yeah, but that's totally, I do it too, dude. It's like totally the thing that happens is you just start trading it and doing something dumb. I actually got myself out of doing that. And then what I started doing instead was I'll just take too big of size when I shouldn't. And that's what led to the stats that I was showing you, those big down days that I had. That had more to do with me sizing up in situations where I probably shouldn't have. No, listen, I'm only making like $100, dude, because I'm trading micros.
100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 100 bucks, dude, because I'm trading micros. 1
He does claim he's doing intraday, though. You're going to have to pop on Discord and show me a picture of stats like in Journalytics or something then. Because that sounds like wildly successful stats that you have to show me to get me to believe. My wife should be back by now, I would think. Yeah, I should quit on those days working. I don't know what it is about. Well, actually, I do. I don't know how to deal with it. When you start losing, your decision making becomes impaired. It's really hard to stay logical through all of that. I think something that helps is walking through that process that I was just showing you. Like, what are the expected flows, etc., etc., etc. Right? If I had been doing that like last Friday when I took a dumb trade, I lost 100 on that. What was it that happened on Friday? Oh, it's the CPI. It was the CPI. Yeah, I'm okay with taking a loss on that one. So you know what happened there on that one last Friday was like, oh, okay, we're gonna take it. We're gonna do a big one, because I want to try and be short the treasuries going into FOMC. So I want to size up so that I can take some profits and then hold it through. And then the day before the CPI didn't work out, and then on the day of the CPI I stayed out, but I kind of thought, well, we might see some stuff going the other way. So I put a few contracts on when I shouldn't have, and I didn't get the move that I wanted. So I was like, it was kind of a little bit of a YOLO, that one. When you're winning, your decision making can be even more impaired. Maybe. So you know what I find happens when I'm winning? So one of two things happens is one, it's so fucking annoying, dude. I don't know how I sort this out. I'll either hold it too long or quit too early. So I'll have days where I probably should have been making, absolute rock star huge runners that you just hold all day, and I'll just take like the first little bit of the move and get out and be done. Right? And then I'm like, why did it get out? Why? Right? That's the first one. And then the other one is I'll hold it all day, and then some other crazy thing happens and wipes away all the profits. I think that the reason that second one happens is because I start to try and get those runners in situations when I think it should run, and actually it just ends up being volatile. So like here today is a good example and why I kind of played it the way that I did. Because if I really thought that it was going to run, then I should be like, yeah, they get a pullback, but we'll move down eventually again. But given this situation, what we're more likely to see is just volatility. Like you can see there is like flow going the other way, and there wasn't even any kind of like informational change or anything like that. It just flipped because of the volume. Like there are just too many people trading, and it's too mixed that you just get volatility, and trying to get a runner to happen is you're really trying to force something that's not likely to happen. Watch, I'm going to say that, and then they're just going to trend all next week because of what happens in the FOMC. just to add irony to it. But this is part of why I come back to this thing. Like, okay, go rewind 2 weeks. I was doing amazing. I was doing absolutely amazing, and I had several months. I had like 2 months there. Really solid performance, right? And I could go and I could show that to people, and I could hold that up forever to be like, yep, I'm awesome. You should trade the way that I trade. But number one, I don't necessarily want people to trade the same trades that I trade. And you shouldn't follow people anyways, right? So I don't even try and use those arguments. I mean, I could really pull more people in if I use those kinds of arguments, I'm sure. If I just came, oh, look at how amazing I do all the time. Screw the stats up, size up on things, take really big risks so that it almost always looks good. You know? There's lots of people that do that. They get pretty popular doing that. I don't care about that. What do I care about? I want to help you guys. I want you guys to be successful. And I want you guys to enjoy being here. Those are my primary concerns. And that wasn't always the case, but it's kind of coming to I'm realizing now my own trading is not that important. Sometimes it should take precedence and I should, do it. And of course, trading helps you guys. But that's the most important. Do you like? Of course, I like chatting with my wife. We don't talk about the market. She doesn't like talking about that stuff. So I'm just kind of wondering if I should read much into that other little step lower in the 5-year or not. I think that it may have just been some movement in the spreads. The ES is kind of like pointing down again, like maybe they're going to threaten to test the lows again. I'm a little unsure about that one because it kind of looks like it's just an overextension and pull back to the mean, but no, we don't talk about trading stuff. I'm trying to convince her to become a performance coach, and then maybe she could help me with that stuff. Because again, the problem is, okay, when you lose, your brain chemistry changes. How do you get yourself back into the spot where you're going to make good trades and good decisions again? It's kind of hard. Although one of the things that I think is with the way that I trade is that if your expected order flow for the day doesn't happen, then it just doesn't happen and you don't have a trade. It doesn't necessarily give you dozens of trades. Now you can try taking the trade multiple times, thinking, well, okay, they're just messing around, but eventually they're going to do it. Could. Performance coach lessons on the channel would be gold. Yeah, it would be. You know what? I tell you what, with the psychology side of trading, I made this realization when we were talking about it, and it was such an interesting realization to me. We've talked a lot about how the psychology isn't going to help you if you don't have an edge, right? But the other realization that I had is that the psychology information is probably the most reliable information you're going to find in trading, right? Like it might be useless to you because you don't have other edge, but by learning that stuff, you are learning useful things that are going to be useful and that are going to be useful. It's the same path that I talked about. Like we showed how it's easier to find edge through informational inefficiency, right? And that's something that is well supported by the evidence and that we can pursue without having to worry about, are we wasting our time? Because you're going to lose money doing it for a really long time, right? Well, it's the same thing with the psychology. You can go and you can learn the psychology, and as long as they're using like peer researched methods and information, and there's going to be a lot of that on the psychology side, you're learning stuff that is helpful, even if it's not really going to affect your results right now because you don't have edge, right? So it was kind of like this dichotomy. It was like it's probably the most reliable information, but it's also for where most people are the most useless information. But then for the people that do have edge, it's the most useful information you can get. Well, I have a trading plan. I walked you through it, right? And we followed our plan today, and I think it worked out pretty well. We made $1. When your mind is process driven, you can get out of bad plans quicker. You realize you don't have. Yeah, I think that might be something that I need to work on, huh, Kyle? Because I really should have been able to pull more out of that trade than I did. Like, I even kind of pointed out, well, this isn't in line, and I kind of waited a little bit, and then when I finally decided that I wanted to get out of it, it was like too late. Everyone has to find their own way. I like algo trading. Yeah. Well, the thing that I was saying earlier about it's easier to find edge in an informational inefficiency than it is a statistical inefficiency. That doesn't mean that statistical inefficiencies don't exist. It just means that it's a lot more work than people realize. Doing the programming route is so crazy hard. Like you don't even know. I've literally programmed hundreds of these strategies and they're all kind of like meh. I'm trying to go into the machine learning route now too. I think that machine learning could help me in my day job too, but I've got TensorFlow working. So it took me a little bit of work. I don't understand anything about the thing that I've got running, and it's not processing real data in NinjaTrader yet, but it is TensorFlow. It runs, and they communicate with each other, so that's good. Icebergs are an epiphenomenon. They can be an indication of more selling or buying, which means they don't indicate anything. Well, it could be, yeah. I with the icebergs. So here's the first thing with the icebergs. Number one, if you join the iceberg, you get a situation where you're likely to get filled and still have orders behind you. So that's an advantage. If you know the trade that you're going to make, and you get an iceberg that you can do it off of, it's to your advantage to use the iceberg. Just understand that, right? But it's very contextual, right? I think that your overall conclusion there is right. I can't go and see an iceberg in a random location and really tell too much about it, right? But there are some very narrow circumstances that I have found where you can really utilize an iceberg to your advantage. And there are two that really stand out in my mind. I didn't talk about them in the order flow videos because I don't want to give you guys setups. But the two are, one, if we are on a trend day and you see the iceberg just below the high or just above the low, take it. If it's a trend day. If you're really convinced that this is going to be a trend day, take it, because those are so much fun. Don't do it when it's just kind of like lackadaisically it moves up and then they do the level break setup and maybe it's because sometimes it goes and sometimes it doesn't. Okay. But if it is a trend day, take it every time. Trend day is 1 out of 10 days or something like that, right? I guess it depends on the market. I think in our market, it's actually more like 3 out of 10 days. But if it's a strong trend day, then take it. Otherwise, it's a scratch. The other one is if it is an auction day and you see really, really big icebergs, you can usually get some ticks out of those. How you do that is probably a little bit more difficult, but it can be if you can get filled just ahead of the iceberg and then join the iceberg for your exit is one way that I've done it. Or you can maybe oftentimes if you're really, really looking for it, you might get the hint of a range and you might be able to identify where they're going to put the iceberg before it happens and make a few ticks off of that. It's not much to speak of. It's not a very common setup, but yeah. So those would be statistically based edges, right? So which, like I said, it's not like they don't exist. It's just that they're really hard to find. And when you find it, it might not be worth much. What do you think of them raising the debt ceiling? I don't think anything of it. There's a lot of people that were really mad that they did it, but I was like, God, why do you not think that it was going to happen? Like, they're not going to I think some of these people really want the U.S. to default on its debt. Like, that's not going to happen, guys. So the fighting over the debt ceiling increasing, I think, is just political theater. Okay, well, it is the top of the hour, so we will be back for the FOMC meeting. Given the way that things are, I think we kind of missed our chance. So we made $1 that will get taken out because of commissions. So, oh well. No, you'll see here. I'll show you again. We're moving down. We're at 12 half, and then on the offer, you see 3,000 to 4,000 contracts absorb at 12 half on the iceberg. It was a trend day. You can join the iceberg, sell at 12 half, get filled, and get a stop run down to like 10. And it's a very reliable trade if it's a trend day. How about trade anything that moves both sides and one gets stopped out and the other makes up for it? Well, now you're talking about arbitrage, right? Now you're talking about buy ZF and sell 15 5 years or something. Try and catch the spread or something like that. Can it work? Might work. You probably need to be fast though, because getting the fills is hard. Hey guys, I'm gonna go. All right, come back for FOMC. It's gonna be crazy. In the meantime, stay profitable, friends.